Hope everyone is doing well and had a good day. As always, if there is some sort of mic issue, go to YouTube. If you're on YouTube, go to the settings. There's a gear icon on the bottom right, and see if you can adjust the quality. And with that, let's get to today. So today, I thought the most important piece was yesterday. Here we've had a pretty strong rally, and this was yesterday, July the 18th. And if you look at a Globex chart, it's easier to see. On the Globex chart, we've had a pretty decent size bull bar. So buy climax, a doji, so a pause, another buy climax. I thought the odds were today would be a trading range day and probably not a bull trend day. Easier to see if we look at go to a 240-minute chart. You can see it right here. Lots of buy climaxes. So strong rally, buy climax, pause, three pushes up, and then a pullback. And then we kind of formed a triangle. And then we got another buy climax and a rally. So here, when you look at this bar right here, and you look at that, you think, gee, that's the best looking bull bar of the rally. And arguably, I get it. This could be the best bar. But whenever you get a strong bar closing near its high, it increases the risk that it is climactic and that it's probably going to pull back. Someone said it looks like consecutive wedges. And that's all true. Consecutive wedges, what they're talking about is here. There's a wedge here, maybe a wedge here. 1, 2, 3. Consecutive wedges, you can kind of see it as parabolic wedges. My problem here is everything here is minor because if we go to a weekly chart, just look at this. Worst case, do you really think we're going to undo a lot of this damage? Now, we could easily get down to 4,400, which is basically, is it the low of July? It's pretty much the low of July right here. And on the daily chart, that would be all the way right here. So what are the chances? This kind of brings up an interesting discussion. This is a daily chart. What are the chances that we're going to go all the way from, let's just call it 4,600? So what's the chances we go up to 4,800 before we go down to 4,400? And I think the odds are we're probably going to pull back. I think it's low probability that we go up to 4,800 without pulling back first. So to me, I think we're probably going to be sideways in this area. But who wants to sell right now? You're selling a pretty tight bull channel, and it is climactic. So when I say climactic, my expectation is a pause lasting at least a bar or two. And right here on the daily chart, my real expectation is that we're going to fall below a prior bar. Go back to today. So on the open, my one thought was we've had consecutive buy climaxes yesterday. Buy climax here, buy climax here, another one here. We formed a triangle and then we broke to the upside and got 2 or 3 legs up. We did get a sell off here, but I'm expecting after consecutive buy climaxes in a strong bull trend day, at a minimum, I'm expecting 75% chance of 2 legs, 75% chance of sideways lasting 2 hours, 50% chance that we get a rally on the open and then we go sideways. However, even if we get the bull trend from the open, there's a 75% chance that the market is going to go sideways for 2 hours, typically beginning before the end of the second hour. So because of that, there's only a 25% chance that today was going to be another strong bull trend. So at this point, bar one, good bar for the bulls, test of 4,600. 4,600 is an important price level, but you have to think about context. 4,600, if you're selling at 4,600, let's say you're a bull and you're taking profits, you bought, or better yet, if you're a bear and you're selling 4,600, the big round number, Are you selling it on a 5-minute chart or are you selling it on a higher time frame? You're probably selling it on a higher time frame. So what does that mean? That means that if we zoom out and look at all these major prices, it's hard to see, but the market hesitated right at these numbers. That's not the example I'm really looking for. But the point I'm making is we could rally 10 points above 4,600 and then pull back to it. So I think a lot of traders, if they're selling at 4,600, they're willing to scale in and they're probably using options. They're willing to hold onto the trade. So bar one, is it buy the close? I don't think so. We're probably going higher, but better to wait for consecutive bull bars. We rallied and sold off into the close. So there's a tail on bar one. Bar one's a breakout. It's accepting the gap from 81. That's good for the bulls. But this tail is a reminder that something is not quite right. And then we got bar two. Bar two, a strong bull bar. Is this consecutive bull bars? And does this mean the market's always in long? It does mean the market's always in long. However, context is not ideal. We have a breakout on bar two, good for the bulls. But bar one has a big tail. And like I said, we're at 4,600. And I think the odds are we're going to be in a trading range. This is strong enough that the first reversal down probably will fail. If bar three is a big bear bar closing on its low, I would get out below bar three. Yes, it's a 2-bar micro channel, but on a smaller time frame, we rallied up here and pulled back on one and we rallied again. So if bar three is a bear bar, it's technically a two-legged rally. One, pull back, two, and then a sell off on bar three. And then bar three is a bear bar. So again, are there buyers or sellers below? There's probably buyers below, but again, I don't think the math is wonderful for buying below three. What about selling below three? I think it's probably better to wait for 2 or 3 consecutive bear bars. But if you do, you can put a stop above 3. But I think most traders, if I'm looking to sell below 3, I would rather wait and see a strong move down. And why is that? Think about what I just said. So if you're watching the recording of this after the fact, rewind what I just said a couple seconds ago about bulls buying below this bar. If you're a bull and you're buying the low of 3, how much room are you going to give the market? In other words, how much risk are you willing to take on? This is a low to sell setup on a smaller time frame. And if we start to sell off, we could sell off really quick. So a lot of traders, if they're buying below 3, I'm going to kind of move this over so it's easier to draw it. But if they're buying below 3, a lot of them, you could argue, might use a stop, a measured move down of the bar. And the reason for that is their logic would be if I'm a bull and I'm buying the 3 low, I don't want the market to go 1 times against me. And if I'm a bear and I'm selling below 3, if I can make 1 times my risk, let's say my stop is 1 tick above the bar, in general, if the market will go down and allow me to make 1 times whatever my risk was initially on the trade, that's probably strong enough for a second leg down, which is why a lot of traders would be quick to get out if this bar went down and pulled back. It's not a great example, but maybe 31 yesterday. 31 yesterday kind of works. If you bought the low of 31 or even the low of 30 right here, betting on leg one pullback and maybe a second leg down. Let's say you bought the 30 low and 31, the market went against you. And look what happened. The market went down, disappointed the bulls. And when the market retested the 31 low, a lot of traders got out. Here, those bulls that didn't get out, who bought the 31 low or the 30 low, are even further disappointed. So what are they going to do on a retest? These tails are pullbacks. The market sold off intrabar and pulled back. The market sold off intrabar and pulled back. And look what happened on 33. So everybody's trying to buy, they're trying to sell somewhere up here. And that will increase the probability of a second leg. So we got a bull bar and then a sell vacuum test of support. So back to today. Doji on bar 4, probably sell buyers, probably sellers above, but the sellers are probably scalping at best, which means we may trigger the buy above 4 and just pull back to the midpoint. So I would not sell above 4, but 4 is a bad high one buy. But there will be some traders who look at 4 and say, yeah, it's a weak entry bar for the bears that sold below 3. So there's probably buyers below 4 scaling in lower. And you can see that's what happened on 5. Bulls that bought below 4 and the market went up on 6. 6, we triggered the high one buy. You can argue it's a micro double bottom on 5. We went down on bar 3 and 4. We pulled back. We went down again on bar 5, and then we rallied. So it's 2 legs down. What about buying above 6? Traders will buy above 6, betting that bar 1 and 2 is strong enough for higher prices. You will have some traders, though, who bought the close of 2 and they're disappointed by bars 3, 4, and 5. So, what are they going to do back at the 2 close? You know, those traders are going to look to sell. And that's in part why we went down a little bit right here. But for the bears on 7 were unable to get a bear bar closing on its low. So who is going to sell the 7 low? I suspect not many traders. And because of that, that increases the chances that the market is going to go higher. 8 rallied in a doji. Probably buyers below 8 after a 4-bar micro channel. But my one overall issue with the bulls is this is a lot of risk. If you're buying the close of 2, putting your stop below 1, you're taking on a fairly the range of those 2 bars are big, and it's the first 2 bars of the day. You automatically know there's a 50% chance, one moment, there's a 50% chance, 50, that the market can get a major reversal of the first initial move. So there's a 50% chance in general this will fail at a minimum. If you include, one second. So, anyways, big bull bars probably going to let me move that out of the way. There we go. Big bull bars, probably 50% chance we may reverse. And overall, my issue with this so far is to me, there's a 25% chance that we're going to get another bull trend from the open. So I think we're going to get a trading range. And if we're going to get a trading range, the open is not going to be at the extreme. More likely, the open is going to be somewhere in the middle. So right now, if you think about the bar, there's not really a way to draw this. Let me see if I can do. Let me try one thing. One second. There we go. Let's see if this works. So right now, if you think about the open, if you think about a daily chart, I'm always thinking about the formation of the bar on the 5-minute relative to the daily chart. Right now, the bar has a small tail. It's kind of hard to draw this. And we're about like this. It's a little, dramatic for the range, but that's the daily chart. And if you think about it, for the bar on the daily chart to close as a doji, we've got to sell off. And if the open's all the way down here, this would be a strong trend bar. Therefore, you have to, for me, my thought is instead of this bar, we're probably forming an extreme of the day, and then we're going to pull back and we're going to sell off somewhere back here. I've actually never used that eraser. And of course, there we go. Interesting. So, my thought here is we're finding the extreme, we're finding resistance somewhere up here. Bar 9, another bear bar. So the market is trying to form a wedge. We rallied on 3, pulled back, rallied on 9, pulled back. 9's a second entry short, but it's a small doji in a micro channel since the 5 low. Probably buyers below 9 scaling in lower. But there's bears. The bears sold below 3 and they sold above 3. And right now, when you look at this market, yes, it's always in long, but do you feel a sense of urgency to buy, or do you feel confused? When I look at it, I sense that the market is confusing. It's not all that clear. And because of that, it makes me think that the market is probably going to go sideways, more sideways. Not mean to do that. Bar 10, a high one buy. We broke out on 9, pulled back. And 10, it's an okay swing buy, taking a chance that it's a trend from the open and we're going to continue higher. But it's far from the moving average. We have 4,600, the big round number, just below. And it's a possible wedge. 1, pullback, 2, pullback, 3. So there might be buyers above, but what do you think is going to happen above 8 or 9? Look what happened above 3 when the market went above 3 on 8 and 9. The market sold off. And then we have a strong bull bar on 11, but it failed to close above the 9 high. So bull bar, yes, but it's also a wedge. And if this bar goes a little bit higher and reverses down, that would trigger a wedge top, and that can lead to the high of the day. It's parabolic. 1, pullback, 2, pullback, 3. Whenever you see a breakout, you have to learn. I think it's really important to understand. A lot of times, every breakout is a vacuum test of support or resistance. Most of the time, the support or resistance isn't that far away. So, someone mentioned, it's just on the top of my head. I saw a comment about it. Someone was talking about the dollar yen and how the dollar yen has had a big sell off. And that's true. But when you look at this, what do you notice about this right here? It's a sell vacuum. It's strong enough that there's probably going to be a second leg. But look what happened. The market raced down, maybe to the bottom here. Maybe it's right here, and bounced. So the low right here, and where I'm getting at is this is arguably the bottom of channel. We had a strong rally, pullback, and then channeled up. But we vacuumed down to this area and traders bought and the market bounced. Even the bulls that bought right here, they made money. We have a strong rally right here, but look to the left. It's a possible buy vacuum test of this area. So the bulls who bought right here, the bulls who bought over here and more lower, they're taking profits up here, and the bears know it. So whenever you see big bars like this, you always have to wonder, is this some sort of vacuum test of support or resistance? 12, big bear bar, enough of a surprise. I think we're going lower, but let's see the follow through. At a minimum, there's probably sellers above, which means the bulls who bought the 11 low or the 10 low, they might get trapped. Because of that, whenever I'm selling a bar like 12, I'm always thinking, what would it take for me to buy? In other words, I'm always thinking about the opposite, the bull case or the bear case. If I'm a bear on 12, what would 13 have to look like for me to buy back my shorts? Even if we get a bar like 63 on the next bar, I still suspect probably sellers above. So there's nothing I could think of that's going to make me buy on the next bar. Therefore, we're probably going to get a second leg down. 13, probably sellers above and going at least a little bit lower. And then we tested the moving average on 14. 14, we had a sell off and a pause and a sell off, failed breakout below 5, test of the one close, test of the 4,600 big round number. There's probably sellers above this bar, but it's forcing you to sell in the middle of the trading range. And arguably, it's two legs down. If the bears were really strong, why is 13 a doji? And you can see what happened on 15. The traders that sold the 13 close or above 14, they're disappointed on 15. And I suspect a lot of those traders will look to buy back shorts somewhere lower. But this is strong enough that the first reversal up still will probably fail. 16, the bulls that bought the 10 low or the 11 low right here are able to avoid a loss. They buy this low, the 11 low, they scale in lower. They got out break even. Now, what about buying below 16? I suspect there's probably buyers below, but for me, to me, I'm in sell mode and I think we're going back to the open of the day. So it's hard for me to convince myself, although there's probably buyers below the 16 low, I'm really not all that thrilled to buy below it. 16 is a retest of the 14 high, so it does. So there is logic in buying the 16 low. 17, surprise bear bar. It's possible that 16, it rallied up to here and then sold off, but probably not. It's three pushes down, 5, 14, and 17, but this is strong enough. I think we'll get a second leg. So is 17 sell to close? I think it is. It's probably sell to close and going lower. But the problem for the bulls is we have bar 1 and 2. And you know there's probably buyers somewhere below 1. It's possible if the bears are really determined, it's possible we get a measured move down to yesterday's 81 low, a measured move from the high of the day to the open, projecting down, but probably will not. And then 18 set it all. 18 set the tone for the rest of the day. Really, bar 1 and 2 set the tone, but 18 was just a reminder. If you're a bear and you sold the close of 17, the market went down and then it started to reverse up. So traders were buying back shorts. And because of that, if traders are buying back shorts, you'll have more and more traders start to buy. Now, what about selling above 18, betting on a second leg down after 14? That's true, but 18 is a big sell off and a big rally, which means there's also probably buyers on any pullback. There were bulls who bought on the way up, and they will look to buy any pullback down here, betting on a second leg. So we have a big sell off and a big rally, which means we're probably going to go sideways. 19, low one short, probably buyers below, didn't trigger. 20, we went above 19, and now we're getting a lot of overlapping bars. We're testing the lows of 14, the breakout price where some bulls bought and got trapped. And then 21, looks like we have bears giving up, but it's a possible buy vacuum test of the 16 low. So while I do think 21 is by the close, look where it's forcing you to buy. It's forcing you to buy in the middle of the range, but probably good enough that we're going to go at least a little bit higher. And then we see 22. If you're a bull and you're buying 21 and you think for a second, wow, 21 is such a really strong bar. I'm going to buy. We're almost certain we're going to go up to here. So if everybody's buying the close of 21, why did 22 close like it did? If you're a bull and you're buying based on momentum, is that really what you want to see? Of course not. It's no different than this bar right here. If you're selling the close, what do you hope the next bar is going to be? You want another big bear bar. If you see this bar, think about what it's telling you. The market sold off and everybody was eager to take their profits. If everyone's looking to take profits, it's because they don't think the market's going to go that far. If everybody thought bar 18 was going to go to yesterday's close in the next 2 minutes, nobody would buy. Everybody would sell, and we would just collapse to the close of bar 18. So it's possible this is just everybody knowing that we're going to fall below the open, and there's probably buyers somewhere down here. So 21 and 22 is strong enough for a second leg, but there's a problem. There's probably buyers below 22. However, if the bulls were really all that strong, we would get another strong bull bar. Plus, the sell off from the 12 high to the 18 low is pretty tight. It's 2 legs down, but it is a strong enough sell off that this is probably a trading range. But this rally is strong enough that we're probably going to get a second leg. So if I had to guess, we're probably going to get some sort of leg one, pull back, leg two, and then maybe a second leg down. But I do not think it's over for the Bears. So I do believe we're going to test somewhere down here later on in the day. Big bear bar on 23. Is it sell to close? I don't think so. If you're a bear, what if you sold the 18 low? So on some time frame, there was some unfortunate trader trading some time frame. They sold the close of a bar, and it happened to be the low of the move. Somebody just sold at the market, and they happened to enter at the low tick. They didn't panic. Maybe they sold higher, but what are they thinking? If they're still short, if you were short, what are you thinking on 23? Are you happy? No, of course not. You're disappointed. And you're probably hopeful that the market's going to go lower. So because of that, I suspect there's buyers somewhere down here. When I look at 23, it's strong enough for at least a small second leg. The bulls that bought the 22 low and more lower are probably disappointed enough that they may look to buy back shorts at the 22 low, but instead we rallied above it. What about buying above 24? Maybe, but my concern there is it's forcing you to buy relatively high and in the middle of the range. But it might be an okay buy. It's low probability, better to wait for a breakout. If you are buying 24, you're hoping on a test of the high of the day, a rally, pullback, second leg. But my concern is this sell off was tight enough that we may have to get some form of a retest down here. So it's possible 24 is a trap. One moment. 25, strong bull bar. So good for the Bears. Good for the Bulls, probably going higher. It's possible 24 and 25 is strong enough for at least a small second leg, but it's 2 legs up, and we had a big sell off on 23. So I suspect the upside is probably limited. And then a bear bar on 26. 26 is a warning that this is probably a leg in a trading range. 24, 25, strong enough we may get a small second leg, but if we do, that would create a wedge. So we might get a wedge, 22, 25, and then another push. And that would also correspond to a double top here. So it would be a double top, lower high, major trend reversal, where the lower high is a wedge. 27, a breakout pullback buy. So it's a high one buy, but it's a high one buy in a second leg in the middle of the trading range. That is low probability. Plus, this big bear bar is strong enough to make traders think there's probably sellers above and we'll get a second leg down, but the sellers may not come in until a new high. Doji on 28. So bears who sold the close of 26, disappointed 27, getting out break even. And then we rallied on 29, but 29 is a possible wedge. 1, 2, 3. So there might be sellers somewhere up here. 30, bear bar. Not a great sell below, tight bull channel. Probably buyers below, but 3 pushes up. So I wouldn't be surprised at all if the bulls did give up. And instead, the market rallied. And it rallied to a new high and sold off. 31 is a great example of trading ranges. Trading ranges are always trying to, for lack of words, just screw traders. And what I mean by that is a trading range is always gunning for obvious stops. you sell anywhere up here and you put your stop right here, where you sell below 26 and you put your stop one tick above the high of the day, only to watch the market rally, stop you out, go maybe 1 point higher or 3 ticks higher, and turn down. That is just really, really common. And because of that, traders look at obvious stop locations and they fade it. So big bull bar, 21, strong enough bar to buy and put your stop below 21. And then, hey, wait a minute, the market stopped me out and just turned back up. So other traders, maybe they buy a retest of the breakout point here, but then the market goes further than they think and they get out. Excuse me, they get out. Let me get a sip of water. My voice always gets a little dry talking through these videos. Or if you're long here, the market falls below a higher low and then reverses up. And the reason the market's always gunning stops is because it's forgiving in a trading range. So where were we? 32. We rallied and sold off a little bit in the close, closing below the midpoint. It's a bull bar, but it's a micro double top. For the bulls, they're trying to get a bull breakout of this trading range, but you know the odds are there's probably sellers above. 33, double top, a micro double top with 32. Another failed breakout to the upside, but probably sellers above. But bad sell signal below 33, probably buyers below. And then 34, big bear bar. Traders know this is a possible wedge and a double top. So if you bought the 33 low and the market went this far against you, what are you thinking? I'm going to buy this low and then that's my entry bar. You're probably thinking, I don't know, that's kind of disappointing. Maybe I should look to get out break even. What do you notice? I want one person in the comment section to tell me, why is the 34 high important? The 35 high, 33 low, 35 high. What happened there? So what happened at this low and this high? Yeah, Jacob's right. Never got out break even. So what is Jacob saying? If you're a bull and you bought the 33 low and you're disappointed with 34, maybe you bought the 33 low and you scaled in 1 point lower and you think, yeah, I don't know, I'm just going to get out break even. So I don't like the way this is setting up. I'm going to be a smart trader. And instead of getting stopped out, I'm going to be smart and get out quick. So I'm just going to put my stop. I bought the 33 low. I'm disappointed with this bar. I'm just going to get out break even. Wait a minute. The market came really close to my break even price, almost to the tick, and then turned down and it's collapsing. That's because the bulls who bought here are trapped. And the bears know that. The bears were trying to trap the bulls right here, and that's what led to a big sell-off. That's why even here, the bulls that bought this low and scaled in, they were so disappointed that they said, I bought this low and scaled in. I'll be thrilled to get out of my original entry. And that's why we rallied. We tested it a few times and turned down. Look what happened. The bulls, they bought here, they scaled in. The market's allowing them to get out break even, and they're going to sell. The bears know that, so they're going to sell right here as well. And look at the next bar. It sold off enough for them to make a scalp. Strong enough bear bar, 35, probably sell the closing going lower, but a tail on 34, tail on 35, and a tail on 36. That is a parabolic wedge on a smaller time frame. And there's trapped bears down here. So this is probably a sell vacuum test of support, open of the day, low of 18, middle of 18. And the market's probably going to bounce and not go straight down. And you can see what happened on 37. We went below 36, went a little bit lower, and then reversed up. What about selling above 37? Betting on a micro channel and 3 consecutive bear bars closing below their midpoints? You can, but it's the same problem as selling above 18. This is a pretty big rally. So if you're selling above it, there's probably buyers somewhere down here. And instead, the market came near the low of 37. Low one short on 38. Are there buyers below or sellers below? In general, when you get a low one short, there's typically buyers below. And in this case, I suspect there's probably more buyers below than sellers. But the problem with buying here is it may just be best for a scalp. So the bulls that are buying, this is a big enough bear bar that there's probably sellers somewhere up here. So if you are buying below 38, I suspect the upside is limited. And there's going to be bears who sold below 38 and more higher. If you are selling below 38, you probably need a wide stop. We could easily get a pullback all the way to 50%. So 50% would be above 4,600. And then we have a strong bull bar on 39. 39, micro double bottom, but a micro channel since 31. Probably sellers above, scaling in higher. I do not use Fibonacci's. Well, I say that. It's kind of a lie. Everybody uses Fibonacci's. I don't use Fibonacci's like most people would think of Fibonacci numbers. To me, the most important Fibonacci numbers are, I think there's really only a few of them. You could argue it's 50% and 33%, maybe 66%. And really, the second two, let me just explain that in a better way. Fibonacci numbers, you know, I don't want to go into too far discussion with this, but Fibonacci numbers, there's all sorts of them. There's almost a Fibonacci number at every level. Most traders look at 50% and they look at numbers that give them twice the risk, and it really just has to do with risk. So if I'm a bear, if I'm selling here, we rallied from this high and sold off to this low. If I'm selling up here, I'm selling a 50% pullback, which means it's giving me 1 times my risk. But anyways, 39 probably sellers above, but strong enough bar. 39 probably buyers below 40, the low one short. And then we got a second leg up on 40. Do you buy the close of 40? I would not. It's possible 41, if it turns down, would form a low two short. And the sell off down to 39 is strong enough that we're probably going to get a second leg down, which means I think 39 is a temporary low of the day or low of the move, and we'll probably fall below it. 32, an inside bar. The market rallied, sold off, rallied, sold off. So if we rally again and sell off, maybe that's a wedge. And that's what happened on 43. The market rallied above it, forming a wedge, and sold off on 43. 43 is a credible sell below the bar, but this channel is tight and there's probably buyers below 42. So I suspect there might be buyers somewhere down here. Big bar on 44 and traders bought into the close, so we'll probably bounce. I do think the bulls that bought the 42 low will make money, and clearly they did. 45, is it a buy the close bar? It might be, but it's a possible. It's 3 pushes up. We rallied on 37, sold off, rallied on 42 or 43, sold off, rallied on 45. So 46 is a bear bar closing on its low. That may be a trap. Also, it's a really big bar, 45, forcing traders to buy at the moving average. And that's not usually ideal. 46, probably buyers below. And it's possible 46 is a trap. This breakout on 45 is strong enough for a second leg. However, this could be a bull trap. And if it is, we may get a downside breakout, but there's probably buyers below it. And you can see bulls bought below 46, but the bulls who bought the close are disappointed. So most of them are probably going to look to sell up here. That is why this high one is probably going to fail and lead to sellers above. 48, second leg down, and then 49, an outside down bar. Are there sellers above, sellers below, or buyers below? There might be more buyers. We sold off, pulled back, sold off on 48, pulled back, sold off again. So technically, it's 3 pushes down. 49, a bear bar, but you're testing low in this range. And there's probably buyers down here, but they may not come in until somewhere down here. And then 51, we got a strong bull bar. Is 51 buy the close or sell the close? It's probably, that's a tough call. I think 51 is enough of a surprise. It'll probably get a small second leg, but there's a big tail above, and really the bulls need to close above the moving average. Bear bar 52, probably buyers below, scaling in. Same problem as bar 46 though. And then we triggered the buy below 52 and turned up, but it's a bad high one buy, which means there's probably sellers above. And instead of it triggering, we're doing the same thing as 48. We sold off on 54, inside bar 55, and then look what happens. Surprise, surprise. Big bear bar. Is it sell to close? It might be, but it's late in the move, and it's arguably three pushes down. 1, 2, 3. We had a triangle here, so it's a final flag. We're getting a strong, strong bear bar. But if you did sell the close, that's your follow through. If you're selling the extreme of the day at a new low of the day, when look what's happened, 18 broke below 1 and reversed. We're breaking below 18 and we're hesitating. If you're selling at a new low, you want the market to crash, and if it's not, you have to wonder if you're wrong. So 58 reversed up, failed, and now, or excuse me, 57 reversed up and failed, and now 58's turning down. 58, it's possible it's a double bottom with 56. Some bears who sold below the 56 low or the 56 close are disappointed with 57, and they may use 58 to scalp out. And that's what happened on 59. 59 is a doji, but it's possible two legs up and a double bottom. We went down and up on 57, so we went down on 56, up on 57, down on 58 and 59, and up on 59. So if we break above this, we could rally pretty quick. 60, a bull bar. It's not clear yet that the bulls have won, but if you're a bear and you sold to close at 56, you're certainly disappointed with 60. And then 61, we have a strong bull close. So 60 and 61 probably buy the close going a little bit higher. 62, another bull bar, still probably buy the close going higher. And then 63, we rallied. 62 is an inside bar and it's a high one, but it's after two strong bull bars. So it probably buyers above. But when you get an inside bar, it's usually a warning that the market's going to retest it. So strong bull bar and 63 has a pretty decent tail. So there's probably sellers above 63, and we may have to pull back to this area. But the sellers, all of that's minor. Traders are buying the close and scaling in lower. And that's part of why 64 turned down. It's testing this area right here. And then 65, same thing, tested the midpoint of 62, and then we rallied on 66 and 67. Strong enough bull bar, 66 and 67, still by the close. Probably going to get some form of a measured move up. And then 68, another bull bar. And then 69, an inside bar. There might be sellers above 69, but if there are, it's kind of like right here. It's probably minor at best, and we have an obvious target below the 33 low where the bulls got trapped. And we rallied up to that area and pretty much sold off for the rest of the day. So you can see it was a rally, pullback, and a vacuum test of resistance. We rallied, pulled back, rallied, pulled back, rallied again. And the bulls, they're breaking above a bull channel. And you can see as soon as we got to the target, everybody stopped buying. And that's what I mean about breakouts being buy vacuums or sell vacuums of support and resistance. Everybody's just stepping aside, agreeing that we're probably going higher. But once the market reaches some extreme, it can sell off pretty quick. This is actually a great example of an end of day sell off. So whenever you get a rally, you get a buy the close rally that happens too early. So this was a buy the close rally that happened earlier than it should. Often if you get a buy the close rally that starts before 2:30 Central Time or 3:30 Eastern Time, which is bar 72 right here. Whenever you get a buy the close rally that starts before that, it typically will not last into the day, and therefore there's a greater risk that it'll fail. And if it's late in the day, it can fail really quick. So if I'm a bull and I'm buying closes, I would get out, one or two, probably just 1 point below a bull bar, or maybe two or three ticks below a bull bar, because the risk is real that this could happen really fast. And if you're buying closes, you don't want to be buying up here and in 2 bars lose most of what you made. And then we sold off, testing all the way back down to the breakout points here, bar 59. For stop entries, I don't think there was that great of stop entry buys on the open. I thought it was okay to sell below 12, but the risk is pretty big. And if a trader did that, they're probably going to be pretty quick to exit above 14, or they might hold above 14, betting on a second leg. Probably, do you buy above 24? I don't know. Maybe. I think it's a fairly tough call. You could argue 24 is strong enough for a second leg, but if you did buy above 24 right here, and the market on 25 went up and started to turn down, I think a lot of traders would get out. And really not an easy stop entry anywhere in here. There's plenty of limit order trading, but it's hard to sell below 33 or 34 or even 35. So you really just have to take, just sell in the market. And the traders are selling here because they understand the sell off and the tails below the bars. Those are just pullbacks. And I thought it was okay to buy above 60, betting that this was a failed second leg trap and a failed bear breakout at the extreme. 3 pushes down, 118 in this area. So it's kind of like a nested wedge. I remember Al one time in the trading room said he likes to think of patterns or charts as like melted plastic. And what he means by that is nothing is perfect. So when you look at a wedge and you think, gee, the shape isn't all that great, you can call this a wedge, you can call it an expanding triangle. Who knows? But we sold off here on the open of 1. We rallied. We sold off on 18. We rallied. And we're selling off again down to 57. That's a wedge, and that's good enough for me. And because of that, there's a greater risk that we may rally for a few legs. But I thought it was okay to buy above 60 and maybe buy above 66 or 67. But stop entries I thought were pretty hard. I thought stop entries were pretty difficult today. There's just not really, the market was forcing you to enter later than ideal. And that's pretty common in trading ranges. So let me see here. For always in, I thought I was always in long on the close of 2, but for the reasons discussed earlier, not ideal. And I think you can get out below 3, and tough to get long again if you did. You probably sell below 12. If you get out below 14, maybe you sell again below 16, or you sell on the way down, and you probably get out above 22, or I'd even get out above 18, especially after this big bar. If I'm selling and the bar gets this big and it starts to pull back, I'm going to be pretty quick to exit, because on a smaller time frame, I know that the pullback is its own breakout on maybe a 1-minute chart, and most breakouts get a second leg. So if this goes up pretty quick, I can get out and always re-enter. So bears get out, and where do bulls enter? Maybe they enter here, but again, if you get a bear bar, they've got to get out, and bears probably get short again. Do bears sell below 26? I don't know. After 2 consecutive bull bars, I think it's better to wait and sell for another leg up. Maybe the bears sell below 34, but not all that clear. Or they can sell to close at 35. And here, just a mess. Not ideal for always in trading. I'd get out above a bull bar, and I don't know, I'd probably do nothing in here. And if you sold on the way down, maybe you probably hold above 57, but I'd get out above 59 or 60, and bulls probably buy above 60 or on the close of 61. And there's really no reason to get out. I'd get out on the 72 low, or maybe 3 or 4 ticks below 71. And as far as selling, you can take the sell, but that's pretty aggressive. But trading range day, it's not all that unreasonable. Other traders, they can wait for the downside breakout and then sell. Limit orders, limit order trading all day. Bears selling above 1, bulls buying below 3 or better below 4. Bears selling above 5 or 6, scaling in higher. Bulls buying below any of these lows. Bears probably selling above 10, but hard to do. Others selling above 11. Probably sellers above 13. As far as selling above 14, I would not. I would look to sell higher, like the breakout point. Probably, the reality is there's probably buyers at the 14 low, the 1 low, scaling in lower. But when the momentum down is this strong, better to only look to sell. And then when you see the rally on 18, probably buyers below 21, even buyers below 22. But there's an obvious breakout point here after a strong sell off, the breakout point being the 20 high. So if you're buying below 22, you have to be prepared to buy more at the 20 high or the 21 low. Probably sellers above 23, the 23 high right here. Probably buyers below this bull bar 26 or the bear bar on 26. Probably sellers above 26 scaling in, but they may not come in until the high of the day. And here, it was really hard to sell above a bar, but you can sell above probably 38 for a second leg, especially since this rally was rather weak. And all of this was just limit orders. Bulls buying below bars, bears selling above bars, and scalping. And then on the surprise bar, there's probably sellers above 57. But at this point, the market rallied, pulled back, and at this point, it's forming a double bottom. So it's not really a great sell above 57 on 60. Probably buyers below 64 and probably sellers back at 33 low. And that's probably it for limit orders. Let me take a look at a few questions and then I will have to wrap this up. This is a good question. Any advice for someone who only has time to take a trade and step away from the screen? Can you only take Walmart trades? Not necessarily. You know, if I am, what a trader can do is take a look at higher time frames. So let's think through that. You don't have to trade a daily chart, but it all varies. So for one, I would take a look at Forex. And really what it comes down to is there's two pieces to your question. One is you've got to trade small enough to where you're comfortable, but also what time frame. So if you've got, let's say you can look at the trade every hour or every, let's just say every 30 minutes. Or better yet, let's just say you can only look at it once every hour or 2 hours. Well, I would start with a time frame that is workable with that. Forex is a great, I really like Forex markets, especially. I used to try to trade a lot of Forex markets on 5 minute charts, and I would just get eaten alive. And what I realized was the problem with Forex markets on a smaller time frame is the commission is extreme. So my commission was, 15, 20%, and I couldn't survive that. But if I start looking at higher time frames and I start going for 20 or 30 or 40 pip moves, all of a sudden it makes a lot more sense. And with Forex, you can trade, you can have $100 account and risk pennies if you wanted. But I would start with, let's say, a 120-minute chart. And, let's just pick anything NZD, let's just pick USD, Canadian, trying to think. Okay, so here's the US, here's the dollar versus the Canadian. You see three big bear bars. And you look at that and you say, yeah, we're probably going lower. So it's sell to close, put a stop up here, and go for a measured move. This is a little bit extreme. I mean, you have days to hold through this. You could do that though. You see a big bull bar right here, probably strong enough for a second leg. If you're long here, spike pullback channel. So it's a tight channel. The pullback could be deep, but if you buy this close and scale in, you're probably going to make money. Big bear bar, probably going to get a small second leg, but instead, it got both. It rallied back to this close. So if you bought here and scaled in, you made money. If you sold here and scaled in, you made money. So to me, the more I start, the more I learn about price action, the more confident I get with higher time frames. So, I know I'm not answering the question as well as you'd like, but Chase, what I would say is it really doesn't matter. You can look at anything and you'll eventually get more comfortable with higher time frames and you'll be able to use them more. Like if you're looking at the E-mini and you know that yesterday had a lot of sell buy climaxes, so today's probably going to be a trading range, or you're near 4600, all that can come into play. Right here, 120-minute chart of crude oil. We had a big bull bar, probably exhaustion, strong sell-off, rally, pullback, second leg, big bull bar, but it's testing this area up here. And then you get this bar. When you look at that, you think, wow, that's a pretty big bear bar. It's probably going to get a second leg. Hey, we have a stronger bear bar. So what happens if I sell here and put a stop up here? Am I probably going to make money? You probably will. At a minimum, the market's probably going to go sideways and get at least a brief second leg. So I hope I'm answering your question. But as far as, do you trade it any different than you would any other market? Or, do you only take Walmart trades? Not necessarily. I think you have to be, you've got to, there's obviously instances you have to think through where you can't watch the market every second. So, sure, there's the risk that a surprise could happen. You don't want to necessarily, you don't want to buy the low of this bar right here at, let's pretend this is at night, and then all of a sudden take a big loss. But most of the time, if you're reading the market correctly, you can typically try and go for one times your risk. So I hope I'm answering your question. Question, Brad, in the trading room, we discussed the concept of, okay, let me back up. Brad, in the trading room today, we discussed concepts of perversion, traps, in parentheses. Can you identify where this was occurring and how traders avoid these traps? There is a trap, well, in basically every bar. Every bar is trapping traders. As far as, specific examples of today, there's a ton of them. A big one I talked about was, if I can remember, a big one I talked about was the 33 low and the 35 high. Now, your question, can you help us identify where they are occurring and how to avoid traps? You're never going to fully avoid traps. I made a mistake. I sold this close and I sold rather late. And I don't remember where I sold. I think I sold somewhere over here. But, anyways, the point is, I sold down here and I got out and actually reversed along on this bar. So what did I lose? I don't know, maybe a point, 6 ticks. But I made up what I lost by reversing the long. And the reason was I understood there were two things. I was hopeful. It was more or less taking a chance that we would plunge down to the close and close below yesterday's close. It was just taking a chance based on the daily chart. And I knew it was a possible second leg trap, 2 or 3 legs down, not ideal, possible final flag. And then when this bar here, that was kind of my breaking point. I knew, okay, you know, I I'm not willing to hold after this bar. So if I reverse, I know I've got a good shot at 2 legs up. And at a minimum, if I reverse to long, I know there's trapped bears. We're probably going to at least test the 55 high and the 52 high and maybe get all the way up here. And who knows, if I'm real lucky, we may get a strong, buy the close rally. That's an example of being trapped. But the way you start to think through who's trapped is understanding. You have to understand how traders get trapped. If I'm a limit order, and I'll give you the hint. If you really want to figure out how to learn who's trapped, take a simulated account and start fading above and below bars like crazy. Sell above one, sell above two, buy below three, buy below four. And if you do that enough times, if you fade above one, so if you fade the one high, the two high, buy the three low, the four low, the six low, sell above, just fade everything. Well, what happens when you fade 33? You buy below 33 and you buy below 34. You're going to get killed. That's why I said do it on simulated. What it will teach you is there's really one instance where limit order traders get screwed, and that's strong breakouts. If you sell above 59 and scale in, you're just going to get clobbered if you cannot get out. So if you can recognize those instances, you can buy and reverse. But that is a longer discussion than we really have time for today. But I hope to talk more about that soon. Is 57 and 58 an II? So is the 57 and 58 II pattern, which means consecutive inside bars. Let's just pull it up. Oh, I'm looking at 77. Let's go to 50. Okay. Is 57 and 58 the inside bars more bullish, even with the bear close on 58? Yeah, the one problem here is the market sold off, and then on 57 it rallied and sold off. So it's already forming a second leg. If you're a bear and you sold this close and you held through this pullback, you're probably disappointed enough where you get out. I should have done that, and I debated getting out here, but I made a mistake and I held longer than I really should have and ended up reversing later. But I agree with you. It is the context here is probably becoming more bullish, but it's not yet clear. And then we rallied again, sold off. This is where it started to be problematic for the bulls. Can you explain why a breakout from bar 60 to 71, 60 to 71 occurred and why we reversed 72 to 79 so suddenly? Yeah. So I want to kind of play a game here for a second. In the comment section, think for a second. There's a word. So I'm thinking what I'm trying to say here. There's one thing I've said about breakouts today. Most breakouts are, it's one word of support and resistance. So most breakouts are blank of support and resistance. I want someone to give me that answer in the comment section. Exactly. Adam's right. Most buy and sell most breakouts are buy and sell vacuums of support and resistance. Adam is spot on. So this person is spot on to the question. And or test. That works as well. Same concept. So let's go back to find this person's question here. So what they are asking is why did we rally up to here so suddenly and then reverse down so suddenly? And that happens all the time. And can you explain why a breakout from bar 60 to 71 occurred? Yeah, well, we had two or three legs down and everybody got trapped here. Remember, if I was a bear, let's say I did sell the close at 56 and I knew it was aggressive, but if I sold, why didn't I just keep scaling in? Why didn't I sell the close at 56, sell the close at 60, sell the close at 61, 62, 63? Why did I reverse my position? Because I knew that the risk was high that we could rally pretty quick. And I certainly don't want to be short. And instead, I'd rather be long if that happens. So here, this is strong enough for a second leg. But look what I have drawn here. This is a wedge. One, two, three. So traders tried several times and failed, and the market turned down. So, anyways, that is pretty much what happened. Now, 72 and 3, I talked about that as well. Whenever you get a late rally late in the day, if it's just a buy vacuum, if everybody sells out of their position and bears sell to go short, we can plunge. Also, what about the traders who sold the high of 56, the high of 55, the high of 52? Those traders, you know they're probably going to make money. And in fact, it looks like every one of those traders made money. Even a trader who sold the line, it's getting a little extreme how many lines I've got on this chart. But even a trader that sold the high of 59, look at that. It came within the high of 59 is 91 even. The low of this bar is 91.25. So if you're a bear and you sold this high and you scaled in all the way up, the market came within one tick of your first entry and basically allowed you out of the trade. And I'm assuming it did on the Globex as well. Question: what are your thoughts on bar 60? I was going to buy if it closed stronger, but the tail made me hesitate, so I ended up sitting out. Yeah, the market's always trying to get you to think that you're wrong. To me, 60 wasn't all that clear, and I basically reversed long on 60, and it never looks that obvious. My thought was 60 is a big enough bar that the chances of traders just immediately selling the close are low. So it's at least going to make the market stall. And if the market doesn't race up, then maybe we get a low two short and traders will sell. But just look at all the stop entries today. Find one stop entry that had good context and closed on its low or its high. Bar three, it closed on its low, but yeah, it's two legs up. I talked about that. It's a low two short. But do you really want to sell below the low of three? Not really. It's two strong bull bars. So it's really not that ideal. 12, phew, it's a big bear bar, forcing you to sell in the middle of the range. Not ideal either. So let me find some more examples here. Okay, last question, and then I'm going to wrap this up. Katie asked, was buying bar 62 reasonable? Yeah, I think it is. It's buying in the middle of this trading of triangle. We had a triangle right here, and I'm going to get rid of some of these lines. So we had a triangle. We're probably going to test the apex. We broke below it, so it's possible final flag. We're rallying back to the triangle. But when I look at 60 and 61, I think, okay, there's a high probability of a second leg. I know the bears are trapped who sold the close at 56. Therefore, it's buy the close. I was long on the close of this bar. I believe I bought the close. I reversed here, scalped out, and then I bought the close again of 61. The reason I scalped out was I thought this bar was getting a little big and I wanted to take a chance. I didn't think it would get too big, but I wanted to exit and then I was going to buy the close. Even if we closed down here, I was still going to buy the close. But I thought if I exit and enter on the close, I'll probably be able to get in at the same exact price. But here, inside bar 62, probably buyers above and buyers below, even if we pull back briefly. So there might be more sellers above 62, but I suspect it's limited. And you can see that's what happened right here. Some bears sold above 62. They got trapped on 63. They scaled in, and then 65 allowed them out break even. What about those dumb stops today? How can they help me trade better? In what context are they most effective? I don't mean what I mean by dumb stops is support and resistance usually fails in trading ranges. So find anywhere on the chart, and what you'll notice on a day like today, you can pretty much buy or sell anywhere and use a wide stop and scale in and make money. So even if you bought the high close of 11 and you scaled in lower, you could avoid a loss. Or if you even bought more at the low of the day, you could have made money. The market came all the way back to the 11 close. If you sold, let's say you sold the low tick of bar 18 and you scaled in higher, you made money on a retest. The only place you got trapped, even here, if you sold the close at 56, sold more higher, you made money. So the point I'm making is the market's very forgiving. And the only way the market can be forgiving is if it falls below support and goes above resistance. You've heard the same thing about break even stops. Break even stops, for the most part, is a really dumb strategy and it doesn't make any mathematical sense. And the reason it's a dumb strategy is it's kind of like right here. This is a great example. So if you sold below 33 and then you get this breakout 34, 35, let's say you move your stop to break even and you hold for the entire day. Look what would happen on bar 71. The market would stop you out, go a little bit above your stop, and then go all the way back down to the low. If you had have bought above 60 or even above 59, same concept, move your stop to break even after 61 or 62. Look what happened. The market would have stopped you out at the end of the day. So you can pretty much buy or sell anywhere today and use a wide stop and scale in. And that's because limit order trading is very forgiving on a day like today. Okay, last question. If you bought, it's more of a statement. Someone said if you bought the 71 close here and bought more below 75 here, you could have gotten break even, I'm assuming, on this bar. Yeah, that happens pretty frequently as well. Okay, that's all the time I have today. I hope everyone enjoyed this. There will be another video Thursday. The end of day review will be here today. And excuse me, I'm getting kind of sidetracked. Thursday, we'll have another YouTube end of day review. And then Friday, there will not be an end of day review. It'll be in the trading room for those that are subscribed. All right. Thanks for watching, and I hope everyone has a good rest of their day.